Welcome to RBC's Markets in Motion podcast, recorded November 10th, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, earnings sentiment staged a partial comeback last week as the rate of upward EPS estimate revisions for the S&P 500 moved up slightly versus the prior week, but remained below its August high. Second, we run through the latest big picture takeaways from S&P 500 earnings calls. And third, other things on our mind include our work on the valuation profile of high earnings quality stocks within small cap and how we're thinking about the end of the government shutdown. If you'd like to hear more, here's another 5 minutes. We'll start with takeaway number 1. What stands out on the earnings stats? There was no major change on our two favorite reporting season stats last week. Reporting season does remain strong from the perspective of beat rates. Additionally, the rate of upward EPS estimate revisions for the broader market indices improved again last week, but remain well below the August highs. What's actually more interesting is a chart that we added back to our deck on 3Q25 bottom-up consensus operating margin expectations for the S&P 500. This stat came down meaningfully for the index in late October. Tech was the main sector bucking the trend and showing improvement. Deterioration in margin expectations has been masked by strong beat rates, but is a likely contributor to the sour mood seen this reporting season, at least for those paying attention to the details. Also interesting is that consensus forecasts expect small cap net income growth to peak in 2026. Bottom-up consensus forecasts for the Russell 2000 still expect the small cap benchmark to experience higher growth than the S&P 500 in coming quarters. But the data is now showing a deceleration in net income growth in the final quarters of 2026 for the Russell 2000, robbing the small cap benchmark of some of the earnings excitement those bullish on this corner of the U.S. equity market had been highlighting. Overall, earnings continue to provide a solid foundation for the U.S. equity market due to the resiliency of the C-suite, and earnings sentiment improved last week for the second week in a row. But that improvement just wasn't enough to challenge the notion that earnings sentiment peaked over the summer. Moving on to takeaway number 2, color from last week's earnings calls. Most of the key themes we've been highlighting over the past few weeks were intact last week in our transcript reading. On the macro, commentary continues to be best described as mixed, with the best tone from tech and healthcare. On the consumer, companies continue to describe the consumer as stressed, soft, choiceful, and cautious yet resilient, with disproportionate stress on the lower income and a subdued DIY market, as well as with weakness in younger cohorts. On tariffs, companies continue to highlight the complicated and dynamic trade backdrop, the uncertainty this has created alongside some optimism conditions may improve or settle, and how companies are managing through with price increases, supply chain adjustments, and shifts in production. Margin impacts were also highlighted. One company caught our attention when they said, with the Supreme Court hearing arguments right now, there's still a lot of certainty on what happens, and there potentially could be some upside dependent on what the court rules, but I'm certain there would be some reactions by the administration as well on additional tariffs in other areas. Their thinking largely reflects how we've been thinking about this issue in regards to the broader market. And on this point, it's worth noting that last week betting markets shifted hard towards the idea that SCOTUS will not uphold the IEEPA tariffs. On the shutdown, few companies were sounding the alarm similar to prior weeks. Some highlighted modest impacts in the markets most directly impacted, delays in regulatory actions, or commented that shutdown was adding to uncertainty. Meanwhile, others indicated that impacts had been minimal or had been contained, in some cases due to advanced funding. On AI, last week's transcripts contained more of the same on this topic, with companies highlighting strong demand data center growth and its ramifications, and how the technology had added or would add to efficiencies, productivity, and better customer experiences. We'll wrap up with takeaway number 3, a few quick thoughts on small caps and separately the shutdown. We'll start with the price for quality in small caps. As we've discussed the recent underperformance of stocks with higher earnings quality within the Russell 2000 with small cap PMs, one client asked us whether the high earnings quality cohort has gotten cheap. To investigate, we looked at the median multiple of the high earnings quality cohort on a few different valuation metrics relative to its own history. Note, we did not do these charts relative to low quality since it's more difficult to even measure valuation for those low quality names. We found that the high earnings quality cohort looks reasonably valued, though not cheap, on a median forward PE in line with the historical average, but trends look less appealing on sales-based multiples. And last but not least, the shutdown. Stocks ended last week on a positive note as expectations the government shutdown would end soon picked up. That optimism dissipated on Saturday but returned on Sunday amid new headlines out of D.C. While the policy cross currents for stocks are complex right now, in the very near term, we think an end to the shutdown would be beneficial to the stock market, as it did appear to be a contributing factor to the indigestion the stock market experienced last week. But we don't think it will solve all of the stock market's problems, as issues like stretched valuations, the peak in earnings sentiment, and AI jitters remain. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.